Are commercial real estate executives finally seeing a glimmer of hope in 2025 after years of uncertainty? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. According to the U.S. News and World Report's latest outlook, the commercial real estate industry is cautiously optimistic about the year 2025. Despite the challenges faced in previous years, the sector is expecting modest growth and stabilization. This is largely due to easing inflation and improving economic conditions that have been bolstered by the Federal Reserve's efforts. The central bank has begun a rate-cutting cycle, which, while leading to modest growth projections of 1.7% for 2025, is viewed as a positive sign by many in the industry. While geopolitical conflicts continue to affect investment sentiment globally, many commercial real estate executives surveyed by Deloitte are anticipating revenue growth. After 2 years of negative outlooks, optimism is returning to the industry. This sentiment is particularly interesting when we consider its implications for multifamily and tenant leasing sectors, which may see increased activity as economic conditions improve. In the Kitchener-Waterloo area of Ontario, we're witnessing a similar cautious optimism. The region has been experiencing steady growth in its multifamily and industrial sectors, driven by a combination of local economic resilience and strategic investments. This can be likened to the broader U.S. market, where the slow and steady economic expansion is expected to fuel growth in these sectors. For those in the commercial real estate industry, both in Canada and the U.S., the outlook for 2025 seems to be one of cautious hope and strategic growth. According to recent data from CBRE, underwriting assumptions for core United States multifamily assets showed improvement in the first quarter of 2025, while those for value-add assets saw a slight decline. Sentiment from both buyers and sellers grew more positive for both core and value-add assets, despite the Federal Reserve signaling a slower pace of interest rate cuts this year as it waits for clearer direction on policy shifts under the Trump administration. In the first quarter, the average core multifamily going-in capitalization rate decreased by 6 basis points to 4.83%, while the average exit capitalization rate dropped by 3 basis points to 5.00%. Core unlevered internal rate of return targets fell by 6 basis points to 7.58%. These core underwriting metrics are now aligned with mid-2023 levels. The spread between going-in and exit capitalization rates for core assets widened to 19 basis points in the first quarter. This gap is expected to expand further over the next 2 years, as going-in capitalization rates compress more than exit rates due to ongoing rate cuts by the Federal Reserve. In CBRE's quarterly multifamily underwriting survey, 16 out of 19 tracked markets showed stable internal rate of return targets for core assets in the first quarter. 3 markets, Los Angeles, Miami, and Washington, D.C., saw a decrease in their core asset internal rate of return targets, and for the first time in 3 years, no markets reported an increase. Core asset buyer sentiment surged to 65% positive in the first quarter, up from 44% in the fourth quarter of 2024. Core asset seller sentiment also improved, with 67% of sellers adopting a neutral stance compared to 57% in the fourth quarter of 2024. Value-add buyers showed slight improvement in sentiment, while value-add sellers experienced a shift toward greater neutral sentiment. Overall, sentiment improvements were most pronounced in the Sunbelt across all property types, with San Francisco showing positive sentiment for core assets. Underwriting assumptions for annual asking rent growth remained steady at 2.7% for core assets and 3.1% for value-add assets over the next 3 years. This stability aligns with a recovery in rent growth following a significant wave of new supply in many tracked markets. For value-add assets, the going-in capitalization rate rose by 7 basis points to 5.32%, and the exit capitalization rate increased by 3 basis points to 5.42%. Unlike core assets, whose spread between going-in and exit capitalization rates expanded in the first quarter, the spread for value-add assets narrowed by 10 basis points for the second consecutive quarter. Unlevered internal rate of return targets for value-add assets increased by 2 basis points to 9.81%. 7 markets saw a decrease in going-in capitalization rates for core assets: Atlanta, Chicago, Houston, Los Angeles, Nashville, San Francisco, and Washington, D.C., while Indianapolis experienced a slight increase. None of the markets saw changes of more than 25 basis points in either direction. For value-add assets, two markets, Austin and Miami, saw lower going-in capitalization rates in the first quarter compared to the fourth quarter, while four markets saw higher rates. Despite slight weakening in overall value-add underwriting metrics, both buyer and seller sentiment improved across core and value-add assets in the first quarter. This positive shift occurred even as the market awaits more clarity on the Trump administration's policy changes. Looking ahead, we expect continued momentum in the multifamily sector as investors seek to capitalize on improving market fundamentals, particularly in the core segment. In the first quarter of 2025, Dallas's office market experienced a significant shift, achieving positive net absorption for the first time in 10 quarters. According to Cushman & Wakefield, the net absorption reached 272,890 square feet, marking a remarkable improvement of 952,000 square feet quarter over quarter and a 2.7 million square foot improvement year over year. This positive trend was observed in both direct and sublease spaces, with the largest move-out being 88,000 square feet and the largest move-in at 83,000 square feet. Andrew Matheny, a senior research manager at Cushman & Wakefield, noted that many tenants have now downsized or right-sized in response to the remote and hybrid work models. This adjustment has allowed the market to reach a tipping point, resembling the traditional Dallas-Fort Worth market, known for its positive job growth and absorption rates. The Las Colinas submarket led the way, with the highest net absorption at 187,394 square feet, followed by Legacy/Frisco, West Fort Worth, and South Lake/West Lake. Conversely, Far North Dallas and the Dallas Central Business District reported negative net absorption. Moody's Analytics reported that office-using employment in the Dallas-Fort Worth area grew by 22,970 jobs, a 1.9% increase from the previous year. Despite some economic uncertainties, such as tariff updates and inflation concerns, the office-using employment levels remain 18.4% above pre-pandemic levels and are expected to grow by 3.5% over the next 2 years. The report from Cushman & Wakefield also highlighted a trend of out-of-market relocations and a limited supply of new construction, which could lead to continued positive absorption. Office vacancy rates are expected to peak this year, but are anticipated to improve through 2026 and 2027. The first quarter of 2025 saw a decrease in overall vacancy rates for the first time since the fourth quarter of 2022, although year-over-year vacancy rates remain elevated. New construction levels are at their lowest since 2012, with only 2.1 million square feet under construction. Vacancy rates vary significantly across different asset classes, with stabilized trophy Class A spaces having a 12.7% vacancy rate, lower tier Class A at 28.2%, and Class B at 22.4%. Despite these vacancy trends, asking rents in Dallas increased by 2.8% year over year to $32.94 per square foot in the first quarter of 2025. This rent growth is attributed to the inflationary environment and the demand for amenitized spaces. Matheny from Cushman & Wakefield suggested that as trophy spaces fill up, tenants are likely to move to Tier 1 and Tier 2 buildings, which could tighten vacancy rates and potentially drive rents higher in these classes. Retail real estate is experiencing a significant boost in demand, especially for high-quality developments. Developers are seizing opportunities in smaller cities by opening large-format malls to capitalize on lower land costs and rising consumer aspirations. Knight Frank India's primary survey highlights that the advent of new shopping centers has led to a surge in retailer preference for Grade A assets, causing a high vacancy in Grade C structures as better-performing malls improve operational metrics. This trend is reshaping the retail real estate landscape in India. The retail demand in India is expected to strengthen in 2025, supported by a robust supply pipeline that is projected to exceed the levels of 2024. New developments are scheduled for completion across multiple Tier Y cities, driven by changing consumer behaviors, economic shifts, and a growing demand for diverse shopping experiences. According to CBRE, domestic direct-to-consumer retailers continue to show a growing inclination toward retail space absorption, emphasizing personalization and increased access through social media and quick commerce. ICRA anticipates a 7 to 8% increase in rental income for retail mall operators in fiscal year 2025, driven by healthy occupancy levels and rental escalations. The top 6 cities in India are expected to see a new supply of 9 to 9.5 million square feet in fiscal years 2025 and 2026. Despite a rise in vacancy levels to 21% as of December 2024, occupancy levels are expected to sustain at 79 to 80% by March 2025. This is attributed to segments like hypermarkets, food, apparel, accessories, and jewelry driving consumption, along with a recovery in family entertainment centers. The Indian retail industry is poised for significant growth, with its market size expected to reach 2,500 billion United States dollars by 2035. Factors such as rising disposable incomes, increasing urbanization, and a young tech-savvy population are contributing to this vibrant growth. Future trends point to hybrid retail models, smart malls, and improved consumer engagement strategies. Malls are transforming into experience hubs, incorporating entertainment, dining, wellness, and digital innovation, ensuring they remain central to urban life. Tier II and III cities in India are witnessing a retail boom, with 25 million square feet of new retail developments expected over the next 5 years. Developers are capitalizing on growing consumer demand and the availability of land in these emerging urban centers. The upcoming mall supply in these cities will be of significant scale, with a projected average gross leasable area of approximately 375,000 square feet. Major domestic and international retailers are expanding their footprint in these smaller towns and cities, driving the surge in mall supply, which is estimated to exceed 26 million square feet by 2030. In recent news, Newmark Group Incorporated has arranged the sale of a significant student housing portfolio, marking the largest transaction of its kind in the United States so far in 2025. This portfolio consists of 5 properties, totaling nearly 1,250 units and over 3,690 beds, spread across 4 states: Florida, Texas, Indiana, and North Carolina. The properties are strategically located near top-ranked universities, each with an average enrollment of over 47,000 students. These institutions include the University of Florida, Texas State University, Indiana University, North Carolina State University, and the University of Texas at Austin. Positioned within an average distance of less than a mile from their respective campuses, these assets offer premium amenities tailored to enhance the student lifestyle. Features such as swimming pools, fitness centers, outdoor recreation areas, and study rooms are included, catering to the needs of today's students. Ryan Lang, Executive Vice Chairman and Head of Student Housing at Newmark Multifamily Capital Markets, expressed that this record-breaking portfolio transaction underscores the increasing demand for high-quality student housing assets located near prestigious universities. As student enrollment numbers rise and campuses expand, investors are actively seeking opportunities in these well-located, resilient, and attractive asset classes. During the first quarter of 2025, Newmark successfully executed student housing sales and financing transactions exceeding $1 billion, building on the momentum from the previous quarter, which saw over $1.5 billion in transactions. This performance highlights the ongoing strength of the student housing sector as investors continue to target rapidly growing university submarkets throughout the United States. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.